Hey there, macro students. This is Mr. Hooker, and this is video 3 for savings investment in the financial system. So first, I'd like to apologize because I just realized like video 1 for this chapter was 25 minutes. I swear that a little timer on the bottom left here for me said that this thing was like 16 minutes. I don't know if I just misread it or what, but I know that I restarted that video, and so I don't know if something happened, but I swear I thought it was only like 16 minutes, but it came in at 25, and I've gone through it to look to edit it. Well, it's 25 minutes, and it's not like duplicated, it doesn't look like. So, um, my apologies. I really should have broke that up better. But we're going to get started here with the financial system. This is a whole lot of stuff here. So let's break this thing down. Uh, so financial markets are where households invest savings. So most of you probably think that means the bank, but there's a whole lot of other places you can go. And we'll talk about that here in a minute. But the simplest answer is the bank. Uh, so, or the stock market kind of thing. But, well, say, but for savings, it'd be the bank and their accumulated savings or wealth by purchasing financial assets. So, a financial asset, paper claim that entitles a buyer to future income from the seller. So, when a saver lends funds to a company, the loan is the financial asset sold by the company that entitles the lender, the buyer of the asset, to future income. Household can also invest in its current savings or wealth by purchasing physical assets, which are tangible objects that can be used to generate future income, which is a house, piece of equipment, art. It's a little iffy, but sometimes it's a little iffy, but hey, it's still a tangible asset, right? So there are things on that. If you get a loan from your local bank, you and the bank are creating a financial asset, which is your loan. Loan is the financial asset owned by the lender, which in this case would be the bank. Loan creates a liability, a requirement to pay income in the future. They get really kind of testy if you do not make those regular payments. Promise you. Because the financial asset's a claim to future income that someone has to pay, it is always somebody else's liability. So it's an asset to somebody, but it's a liability to somebody else. And this is also why if you ever um, start your career in banking, it's really hard to move to accounting because banking accounting is exactly opposite of the real world accounting. So I started my career in banking. I learned all of bank accounting, and then I moved into the rest of the world and had to adjust to the rest of the world accounting. And this may be why I hate accounting because I understand bank accounting. I understand the debits and credits of bank accounting, and that is exactly opposite of everybody else's accounting, and it's just not good for me. Um, so just a note on how that works for you. So also, if you start somewhere else and move to banking, it's going to be completely backwards for you. So three tasks of the financial system. So a well-functioning financial system is massively important for achieving long-run economic growth. It encourages greater savings and investment spending and ensures that it's efficient. So the three tasks, reducing transaction costs. So one, you want either zero or near zero transaction costs. So as close to zero as possible. So transaction costs are the expenses of negotiating and executing a deal. So let's talk about that for a second. If you have a cost to using your debit card when you go shop, there's a transaction cost on your debit card. Um, if there's a cost to using cash, there's a transaction cost for cash. They should also be able to reduce risk. So financial risk is the uncertainty about future outcomes that involve financial losses or gains. So most people are risk averse, and any financial system helps people reduce their exposure to risk. There are a subset of the population that enjoy risk, whether that be in their jobs or in anything else. These are the gamblers of society. Those people will take those high risks. Um, and they have massive swings. So they're going to be up and they're going to be down. Crazy how that works. But those people are going to see a lot of different things go on with their money. They're going to see a lot of different things go on with their job. It's a whole different thing. One way to reduce risk is diversification. So investing in several different assets with unrelated or independent risk reduces said risk. Third, provide liquidity. Um, so liquidity is a measure of how quickly an asset can be converted into cash with relatively little loss of value. Cash is the most liquid because it can be converted into cash immediately. It is cash. Checks are very liquid, typically, not always. Paintings, art is like very not liquid. Houses are not very liquid. Um, unless it's a hot market. Sometimes it's a hot market. You can sell quick. Um, so that's it. So if it can be converted into cash quickly, it's liquid. If not, it is illiquid. Um, so that's what we look at. Which of these assets is most liquid? Home with a market value of 300,000, checking account balance of 1,000, 3-carat diamond engagement ring, or a rare edition of an out of print book. Your checking account. Financial markets provide a means for reducing risk for borrowers and lenders, reducing transaction costs, or enhancing liquidity. All of that. So loans. Loans, a lending agreement between an individual lender and an individual borrower, typically involves a lot of transaction costs, negotiating terms, investigating borrowers' credit history. To minimize that, corporations and governments often issue bonds. It's not that they don't trust you, but they don't trust you. Um, so bonds is an IOU issued by a borrower. Bonds issuer promises to pay a fixed interest rate every year, a fixed interest payment every year, and to repay the principal on the bond to the bondholder on a particular date. Most of those are 30 years, right? So your typical government bond is a 30-year semi-annual bond. So you get interest payments twice a year, every 6 months. So if you have whatever, $1,000 semi-annual coupon, semi-annual $6 coupon, 6% coupon, you're gonna get 6% interest paid semi-annually. So, you know, 3% every 6 months, bam, and then you're gonna get your $1,000 in 30 years. So that's how that works out. Um, Default is the risk the bond issuer will fail to make payments. Bond with higher risk, higher default risk must pay a higher interest rate to attract investors. So we rate these things like AAA, AA, A, um, triple B, double B, B, triple C, double C, C, and then it's just D. I don't think there's any triple D. It's just D. Um, Once you get down to triple C, anything in the C's and D's, we call them junk bonds. And those are the ones you got to worry about. Like, ain't nothing good there. Even once you get to low B, people are kind of wary about that. The U.S. used to be at the highest level. We've been downgraded a couple of times. We moved up. We got downgraded. We moved up. We got downgraded again. Um, I think we're at the second level right now. Loan-backed securities, it's called securitization. Assets created by pooling individual loans and selling shares in that pool. That's securitization. That's what was going on during the housing crisis. I mean, prior to the housing crisis of 2007. So they were basically selling off pools of mortgage-backed securities. Eh, That's the way it is. Um, People were buying them. Hey, if people will buy them, we will sell them. It's kind of like the old Field of Dreams thing. If you build it, they will come. If you will buy it, I will sell it. Um, so with a lot of loans packaged together, it's difficult to assess the quality of the asset. The crazy thing in the in the pre '07 world of that, they were marketing them all as AAA, AAA, double A. And they could always get somebody to, and you had to get somebody to attest to that they were. And the way that works is you could always get somebody to do that. And what they did was they would started putting like junk ones in there, C's and D's. And if you only put one or two C's or D's in there, those people would continue to pay. You figure that people would continue to pay because it's their house, right? Nobody wants to lose their house. They're going to continue to pay. Put one or two in there, it's not really a problem. They continued to do that. And then they got cocky. They started putting over half of the C's and D's in there. And so this is an all or none. Securitization is an all or none. So they all have to succeed or the whole thing goes south. So when you put so many in there, eventually somebody's just like, screw it, you can take my house. And so they did that. And eventually somebody just went, screw it, you can take my house. And these things started going south. And when that happened, banks started losing. And they did not have the sufficient insurance. So everybody had bet on these things. Nobody had bet against them, but a couple people started betting against them. And like, whatever. If anybody bet against them and lost, the bank didn't lose any money. But as soon as people started betting against them and winning, the bank lost hundreds of millions of dollars, and they didn't have any insurance against that. And that's basically how that happened. So that's that whole busting of the housing bubble in 2008. So stocks are shares in the ownership of a company. If you own a stock, you own a piece of a company. It ain't a big piece, but it is a piece. Microsoft has nearly 8 billion shares. So if you have a share, you're entitled to 1/8 billionth of a company's profit. So that's not really a thing. Stock is riskier than bonds. Bonds get paid first. Stock pays the bonds, right? So that's the way that works. Intermediaries, that's the institution that transforms the funds it gathers from many individuals into financial assets. Um, they are mutual funds, pension funds, and life insurance companies, and banks. So, mutual funds, if you buy into a mutual fund, it is managed by somebody, and they basically just try to, they will pick many diversified stocks, bonds, other kinds of things to make the most money they can. Pension funds kind of do that thing. Life insurance companies kind of do that. They will pick some, but not as many. Banks, they are matching lenders with buyers. Mutual funds, owning shares of a company means accepting risk. So what these folks do is they build a diverse portfolio. Um, so they build a stock portfolio and resell shares of that portfolio to individual investors. If you want the lowest cost, buy an index fund. There's S&P index funds, there's NASDAQ index funds, there's index funds for any kind of index. That is the lowest cost, basically run by a spreadsheet. Um, in 2022, the largest mutual fund company was BlackRock, $10.1 trillion in assets in mutual funds. Vanguard's second largest with 8.1 trillion. Um, so this is Vanguard's the Vanguard 500 index fund, uh, what they have, and you can see they don't have a whole lot of anything. 6.6% of their thing is Apple. Microsoft is 5.58. Amazon is 2.51. Nvidia 1.74. Tesla 1.66. Berkshire Hathaway Class B is 1.65. Alphabet Class A 1.62. Alphabet Class C is 1.44%. ExxonMobil is 1.36. United Health Group is 1.34. So, yeah, I mean, they own a lot of Apple, kind of, but Apple makes money, and so does Microsoft and Amazon. Pension funds and life insurance. Um, Pension fund's a type of mutual fund that holds assets to provide retirement income to its members, and life insurance sells policies that guarantee a payment to a beneficiary when the policyholder dies. All right, we'll stop right there and we'll get back to it in the next.